Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta. Joining me today are Craig Jeffery, Managing Partner and Strategic Treasurer, and Paul Galloway, Senior Director, Advisory Services at Strategic Treasurer. Welcome back, Craig and Paul.
Good to be here, Push.
Thank you so very much for taking the time to share your thoughts with us on topics that impact the world of cash and treasury management. Let's delve deeper and get your perspective on our topics for today, namely China's digital yuan mBridge plan emerging as a challenger to US dollar-denominated payments, Russia's central bank hikes rates to 12% as ruble sinks, multinationals expand use of AI in supply chain management, UK corporate treasurers expect net debt surge despite rising borrowing costs, and finally, CNBC names the top fintech companies from across the globe. Our audience can read articles, interviews, and industry roundups by visiting CTMfile.com or by following the links in our show notes. Let's start today's discussion. Our first story is about China's mBridge plan that is likely to extend the reach of China's digital yuan and other central bank digital currencies and raises the potential for a digital yuan challenge to the US dollar's dominance in daily foreign exchange flows, which total nearly US $7 trillion. While the mBridge platform has been under development publicly since 2017, some American and European observers who monitor it are increasingly worried that it will help China give a head start using digital currencies to revolutionize wholesale payments across borders. The mBridge project involves collaboration between China, Thailand, Hong Kong, and the UAE, along with the Bank for International Settlements, or BIS. Craig, considering the mBridge project's goal is to facilitate the use of the digital yuan for settling cross-border corporate payments, how might the development impact the treasury operations of US multinational corporations operating in these regions, given that these corporations may have to opt for the digital yuan instead of the US dollar for handling large corporate transactions?
I think it'll take a while before they can force that on companies other than in a particular jurisdiction like China. The first mover has an advantage for some reasons for pushing that, but that's not the only thing in play. It's not just a technology question. It's also what currencies do people want to deal with. And unless the country is requiring that, I don't think many are going to be opting for that, and except certain countries, right? Some have offered this not as exclusive. China might try to push that, but other countries are probably unlikely to push it to be exclusive. Now, there's some players, China, Russia's not listed in here, but other countries that want to avoid the growth and the strength of the dollar, want to have other alternatives, or don't want to be subject to sanctions, which are much more easy for the U.S. to implement by using the dollar for trade. I think it's kind of interesting to keep track of, but I don't think this is going to be a significant event for corporate treasurers.
Yeah, Craig, I tend to agree with you. I don't, when I think about this, we know that Asian countries seem to be gravitating towards, central bank digital currencies at a much higher percentage of acceptance than, in Europe and the US. In terms of that region, we may see some organizations that accept trade that way and transact in the yuan, but I don't see that all of a sudden that's going to be become the world currency reserve or a pathway to that for China. Do I think that at some point we're going to compete against that? Yeah, sometime down the road, the U.S. will have something counter to that in the form of a digital dollar. I don't know when that is. I think we still have a long ways to go before we get there. I think about, adoption rates and acceptability. Just because you have it doesn't necessarily mean that all of a sudden everybody's going to gravitate towards that. They're putting a lot into this to get the infrastructure built, to get it out the door. I do think some people will be sitting on the sidelines looking to see how this plays out. But in terms of impact to the US dollar dominance, I don't see that having like a big club effect on that.
Moving on to our next story that will feature in our conversation today. This pertains to Russia's central bank's rate hike to halt a rapid depreciation of the ruble. In a rapid response to the plummeting value of the ruble, Russia's central bank has announced an unexpected 350 basis points increase in the benchmark interest rate, elevating it from 8.5% to 12%. The country's currency, the ruble, has seen a steady decline throughout the year, reaching a critical point with a weakening of 26% against the dollar, making it one of the worst performing global currencies in 2023. This move aims to counteract the ruble's free fall and stabilize its value, which has been hit by a combination of factors including lower export revenues and escalating military expenditure. The decision comes after the ruble hit its weakest level since the 2022 invasion of Ukraine. Since the invasion of Ukraine began, Yale Chief Executive Leadership Institute has been tracking the response of well over 1,500 companies and counting. Over 1,000 companies voluntarily curtailed operations in Russia to some degree beyond the bare minimum legally required by international sanctions, but other companies have continued to operate in Russia undeterred. Paul, how might this significant increase in Russia's benchmark interest rate affect corporations operating in or trading with Russia? And do you think they will manage currency risk and adapt to such rapid fluctuations?
Well, Push, if they're not already managing currency risk, I'd be surprised. I have to believe that they're looking at this and thinking, if we aren't doing something, we should have been doing something. It's not the first time in the last couple of years that their central bank has done this. I think the article notes later on the invasion of Ukraine, they significantly rose the interest rates then, to prop up the currency. So, they've got a lot of self-inflicted wounds going on. It hasn't been a very smooth operation for President Putin over there. It feels like he bit into something that he didn't expect was going to be so difficult to take on and win. I think he thought Ukraine was just going to crumble and fold, and they didn't. And I also think he probably didn't anticipate that there was going to be so much support outside of Ukraine to help keep them in the battle. Putin's got to have a strong currency. He has economic woes. He has military woes. He has a lot of things that are going against him. His trade has dropped, and the economic sanctions that have been put in place have had an impact on Russia. If I'm a treasurer and I have to do business in rubles, I should have put a risk management process or program in place long ago.
I think more of the story here is less on what companies who may still be operating there to the general geopolitical situation. I mean, Russia's a country at war. They started a war, whatever they refer to it as a special military operation. They become a pariah to many, many nations who are against that action. There's a significant level of sanctions placed against them. Now, they're a country with huge natural resources. They're not like some countries, which it's only a service entity. So they have a service oriented economy. So it's pretty massive there that they've had these huge natural resources. Now, some of the changes with the cost of oil and other trade issues are creating challenges for them, even given their natural resources. So these sanctions, to some extent, are biting, and it's the overall set of activities is harming the Russian economy. And they may view that as worthwhile or not, but this idea of greater production of oil than is generally being consumed or putting downward price pressure on that is having an impact. And you can also see, I guess as we look at that from a broader perspective, what is Russia likely to do to respond? They've raised interest rates to try to shore that up. They're also putting a lot of pressure on ships, moving Ukrainian goods around the country. They've done some bombing there. I guess I would think that this is going to create opportunities for more general trade upheaval because these things are biting into Russia. I think they'll try to create some easing of that by using some of the levers that they have. So potentially more turmoil and food and other shipments coming out of Ukraine.
Our next story is about multinationals deploying artificial intelligence or AI in supply chain management. In the evolving landscape of supply chain management, multinational companies like Maersk, Siemens, and Unilever are embracing AI in novel ways, as highlighted in a recent report by the Financial Times. These companies are leveraging generative AI to revolutionize their supply chain processes, from sourcing new supplies to finalizing contracts, all while ensuring ethical and sustainable practices. This adoption has been prompted by changing regulations in countries like Germany, which now require companies to monitor environmental and human rights concerns within their supply chains. Craig, as AI continues to evolve, what trends or advancements in AI-driven supply chain management do you foresee in the coming years that corporate treasurers can proactively harness?
I think there's application to the supply chain for what AI is doing. I know it more from the broader business perspective, what companies are doing, applying, and working on. To see it happening in sourcing and so many other areas of finance is encouraging. It's fantastic. It's to be expected, right? People are playing with it in their personal lives. They're using this to help the organization in different ways. The issue of the supply chain from can we source it? Are there issues? How do we handle it? To how do we deal with our trading partners? Are there security issues and risk? I mean, all of these different ways of connecting requires updates. That's a huge risk exposure to companies across all these different domains. And so being able to turn AI loose to help this makes sense. We receive notifications, it seems like every week, about this or this one particular exposure on the internet to certain types of cyber security threats, to another, to how are you fending and fighting against this. That used to be on an annual basis. Now, as things come up, companies are looking to adapt that. So we're seeing that, even though we're not in the supply chain, we're part of connection. So this is hard to manage the volume of activity, to analyze that and categorize it in a timely manner. A year cycle is not good enough for the financial supply chain or for the supply chain. And so this is helping to speed things along. So the key issue here is these are tools that will shorten the cycle and help companies better survive, thrive, identify issues ahead of time, oftentimes in a manner to be able to prevent something that's very, very significant from happening. Catching it earlier is a significant advantage. AI is helping to do that. And this article is a good story.
I think we're just going to see more and more of this type of activity across various industries. So not surprised on the supply side, shipping management, that, technology is being embraced and utilized. I think about, if I'm a supply logistics person and I have a way to make things more efficient across the whole platform, AI seems like a good way to help you optimize the financing of all that across the entire platform, being able to see opportunities where perhaps, with the older way of doing things, it takes longer to pick up on it, where AI can be utilized to find those opportunities for you, but also just to make the whole pathway run a lot smoother. So not surprised that we're seeing AI become part of platforms like this. Certainly have to manage and mitigate risks associated with new technologies doing this kind of thing.
Couldn't agree more. Moving forward to our next story and shifting our perspective in particular to UK corporate treasurers who expect a surge in net debt despite rising borrowing costs. According to a study by Herbert Smith Freehills, or HSF, in conjunction with the Association of Corporate Treasurers in the UK, there is a significant increase in respondents who are looking to increase net debt this year to the highest level in 5 years, despite the increase in borrowing costs. Based on a survey of and follow-up interviews with Treasury and finance professionals at 88 large UK-listed corporates, HSF's latest annual Corporate Debt and Treasury Report 2023 found that bank debt remains the mainstay of corporate debt financing. The study highlights that corporate debt financing continues to heavily rely on bank debt, although there's a notable shift towards debt capital markets issuance and private placement. Based on the survey findings that you have reviewed, Paul, have you identified any distinctions or parallels between the approaches of US and UK treasurers when it comes to debt strategy, debt diversification, or interest rate hedging?
Capital management is something that's near and dear to my heart. When I think about capital management, whether it's here in the US or whether it's in the UK, the parallels I see are that optimization and utilization of various levers is becoming more prevalent. It should be. The one thing that I feel like sometimes companies get, they're a little lagged on is, they should have been looking at financing, 12 to 18 months ago. They weren't thinking about it at the time. They're thinking about it today. So net debt transfer, we're seeing that people are going to widen their balance sheet. And that's fine. They can lock in the rates. They can manage the rates, fixed or floating. They can hedge. They can do whatever it is that they want to do. But optimization of the weighted average cost of capital is, going to be key to them. Do they have the right understanding of their cash flows? Do they know how their products are going to perform over the next 12, 24, 36 months? Do they have a view of that? Do they understand what their total expense is going to be? It talks about expense in here, interest expense, managing that, optimizing among the different levers that are out there and available. You got to understand what that cost of capital is. Obviously, issuing equity, much more expensive than senior debt. If you're doing something that's in between, you got a variation of that. Preferred funding and also be a viable option for organizations. So you'll see companies out there that will add preferred debt to their balance sheet as another lever. You'll see they may optimize their bank relationships as well. This article talked about a move away from more bank debt to less bank debt. So you get into more of those private deals. Those private deals can be interesting because sometimes they can be strategic in nature. And so it becomes something a little more than just the pure optimization of your weighted average cost of capital, because on the flip side, you may be seeing some type of strategic advantage to accessing that capital funding with that partner. So it becomes a little bit different dynamic. But at the end of the day, whether you're doing capital management here in the US or the UK, optimizing, getting the right levers in place, making sure that it's available for the activity you want to engage in. I think the article made reference to selling assets as a way to raise capital. Some organizations may do that. There is a cost associated with that. The article didn't talk about that. You have lost opportunity by selling off an asset. You just got to understand what that cost is. It's a good article. The survey results weren't necessarily outside of the realm of what I expected to hear. I do think that sometimes companies get a little bit late to the starting line when it comes to opportunity to reduce your cost of funding. Like I said, they should have been doing it, 12, 18, 24 months ago.
I'll take it in a different direction that Paul did. Instead of covering the same ground, we all breathe the same air. We all take in the same oxygen. And because of that, there are implications from one organization to another. If we look at what happened, we went from an era of very inexpensive money. I'll call it free money, unlimited free money that was available. Now, it wasn't quite that way, but it was a significant change as things have tightened. Now there's significant restrictions on most companies in terms of accessing capital. It's more expensive. And for many of the medium and smaller firms, it's very hard, if not impossible, to get access to capital. And I don't know how that is in every single country. I know this article is about the UK, but that's what we're seeing everywhere. If we look back 18 months or so ago, the shift in the balance of power from lenders and borrowers has been very dramatic. It was very much in favor of borrowers before. Now it's moved very heavily towards lenders. Lenders aren't looking to lend as much money. There's a number of factors with the increased interest rates that exist that they have to pay for, the bank's desire to shore up capital. They're not lending as much. And because there might not be as many impacts to the largest companies that have very, very high credit ratings, there is an impact on the supply chain. And that's to the point about the oxygen we breathe. There has been significant developments in terms of allowing smaller firms to access capital, whether it's through, I can't remember what Amex acquired somebody, I think it's called Cabbage, which helps smaller businesses take funds. Even QuickBooks Online has different capital providers who can inject capital into smaller companies far more effectively than the larger banks, right? They're looking at the actual financial records as they go on. That's not been enough to overcome this shift to the power to borrowers who don't want to lend as much, to lenders who don't want to lend as much. This is having a reasonable impact that most companies want to borrow more as a safety measure. We're intentionally risk averse. This kind of fits into what we're seeing in the market generally, and the fact that we have some significant interrelations here.
All really good points, Craig. That access to capital through traditional avenues is certainly been drying up for a lot of organizations, especially smaller companies or companies that they aren't as creditworthy as others. And so there's been pullback. Central banks have been, working on the money supply, trying to slow things down. So now it becomes, for those lenders, there's other things that they're looking for before they're going to lend to organizations out there. So the easy money, as you termed it earlier, that's gone away. It's not as easy, which brings up these private deals a lot more. Organizations just managing their capital, they got to understand what those costs are.
Yeah, you make a great point, Paul. The next news item that merits discussion pertains to CNBC naming the world's top 200 fintech companies following months of research and analysis. The list of 200 companies was developed in collaboration with Statista and includes some of the biggest companies in the sector. The Ant Group, Tencent, PayPal, Stripe, Klarna, and Revolut, as well as several up-and-coming startups seeking to mold the future of financial services. For this study, Statista reviewed a selection of more than 1,500 companies using over 10,000 data points sourced from annual reports, company websites, news articles, and an open online application form. Of the 9 categories, digital payments topped the list, and neobanking came in second, with 30 companies classified as financial institutions operating exclusively digitally without physical branches. Craig, my question to you is that digital payments and neobanking are highlighted as prominent categories in the list. Do you think this categorization will be of particular relevance to corporate treasurers when considering partnerships or collaboration with fintech companies?
I don't know that it's going to be that relevant to them making decisions. I guess when I looked at this article and that you wanted to talk about it, a couple of things came to mind that, as a corporate treasurer, I think about. One is from a payments perspective, that's a rapidly growing area. There's a tremendous number of new payment types, and that requires new development, right? They have, more connections, more ability to link into controls and security features, as well as additional data and enrichment. So new payment types, additional security requirements, that's driving behavior. And thus that's pushing innovation to happen, well beyond just efficiency plays. So that's on the payment side. On the neobank side, there's certainly less brick and mortar needed nowadays as more and more banking goes digital. And so neobanks certainly have some advantage there. They don't have some of the physical store or branch debt that exists. They don't have, plant and equipment or real estate debt that others may have to deal with. Most of the bigger banks are reducing the number of branches they have, or certainly realigning them. So there's a shrinkage there of what's occurring. So this type of debt, tech debt and real estate debt, puts a drain on traditional banks that some of the neobanks don't have. But I guess when I think more broadly, when we discuss what's occurring, two things come to mind. The first thing is there's so many people who are more attuned to a couple of these areas for discussion that they would be better served to talk about this than me. But be that as it may, you asked that question. So where is developing happening? It's happening in tech firms. It's happening with neobanks in the banking space. And it's happening with the largest banks that have, the $1 trillion banks that are really pouring investment into the space. And so these three areas are creating developments which becomes the new standard for how people operate. Overall, that's both interesting and exciting because it means better services, better access to information and data, a faster treasury, a more controlled treasury. All these point to developments that we need, better use of data. So I think it's an exciting time for Treasury. We're going to see more of this, and there'll continue to be significant disruption in different sectors here. And so I think it's probably harder if you're a $30 billion bank trying to stay current on development because your focus has to be tied into a technology provider who's developing that you can use. If you're a $1 trillion bank, your challenge is, do you build it yourself or leverage tech firms or do some kind of hybrid? If you're a neobank, you're mostly developing for yourself and trying to make changes as things go on. So every area has to manage their resources and their activities to deliver what's necessary. So it's good for the buyers of these services and users of these services. But there certainly will be some disruption from this.
Yeah, Craig, I think, you're definitely spot on there. I looked at this article and I just looked at some of the statistics here. A third of all the top 200 fintechs based here in the U.S., not necessarily a surprise. But looking at those 9 categories that they have there, you talked about the neobanks versus the tier 1 banks. Tier 1s. I can remember years ago, one of my bank relationship managers at Citibank, he's like, we don't view ourselves as a bank. We view ourselves as a technology company that happens to have banking operations. They said that or delivered that message, on a very consistent basis. They weren't the only one banking partner, at that level that talked about the investment that they have in their technology. Tier 1 banks are making massive investments in tech. So, it's all these other ancillary types of organizations where they can't do that. You pointed out $30 billion bank, much different than a $1 trillion bank. They got to leverage all the opportunities, and some of these things stick out. Obviously, digital payments, digital assets. I think about financial planning and wealth management. I think there'll be more and more trend or disruption in that area, in particular for generations that don't need to do business face to face. They're okay with just picking up their phone and making transactions or cutting deals with organizations to do something that they have a need for. This area of alternative financing or alternative lending also is an area that I think is quite interesting, especially when we think about non-bank financials or partnerships that businesses are having to provide financing or funding when they're not a bank. So I think these are areas of disruption that definitely interest me. And from a standpoint of, the treasury area, all these types of industries or areas of focus that they have in this listing of the top 200 fintech companies. These areas, I think they're going to change over time. I think we're going to see some new things come online, not necessarily a surprise. The last one I make note of, I think this is an area that potentially has quite a bit of upside potential out of this is digital business solutions. When I think about organizations that are building out more robust budgeting or FP&A teams, KPIs, OKRs, those kinds, all those acronyms for monitoring and tracking performance of an organization, that's going to become more and more important. And so platforms like that can definitely help treasurers, CFOs manage that.
Interesting. Finally, gentlemen, what is your choice for the biggest or the most important story of the past week and why? Craig, can I ask you to do the honors first?
Sure. I would say the use of AI in supply chain management, largely because the speed that AI is becoming useful in different areas, and the fact that it's solving current issues rapidly, and it's not the uptake cycle that we're used to seeing with technology. So that's my number one, because it's not just because of supply chain, but because it's impacting different areas of the financial supply chain and finance in general. That's my number one.
Paul, would you concur, or would you have some other story?
Yeah, just looking out there and looking at where some of the economic trends in the U.S., an area that I find a little interesting. I think about how many times I refinanced my mortgage when all the rates were dropping down. U.S. mortgage rates just hit a high of almost closing on 7.2%. It's the highest since 2001, over 20 years. So we haven't seen mortgage rates that high in quite a long time. I think this is just indicator of, economic slowdown, things that, the Fed intended to happen. This is something that I think going to definitely have an impact on our economy. Home buying is going to be down. Refinancing is going to be down. I think, for mortgage companies, this is going to be a rough patch for them for sure.
Thank you, Craig and Paul, for your informative analysis and valuable insights. We would also like to thank our CTMfile audience for joining us on this edition of the Open Treasury podcast. Please subscribe and look in the show notes for the article links. Thank you and have a wonderful week. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.